In the unpredictable journey of life, building a financial safety net is our anchor. It begins with an emergency fund, a cushion for unforeseen expenses like medical emergencies or job loss. Ideally, this fund holds 3 to 6 months of living expenses, accessible in high-yield savings or money market accounts. But the safety net extends further, woven with strands of insurance. Health insurance shields us from medical costs, while life insurance protects our family's future. Auto insurance guards our vehicles, and home insurance safeguards our dwelling. Disability insurance secures our income, and long-term care insurance prepares us for elder care. Choosing the right products requires assessing needs, comparing policies, and understanding terms like premiums, deductibles, and coverage. It's about tailoring policies with riders, balancing growth with liquidity, and regular reviews to adapt to life's changes. In conclusion, building a financial safety net is both an art and a science. It's a fortress of financial resilience, constructed with care, insight, and practicality. Roger, what types of insurance do you consider non-negotiable?
Your emergency fund. So I think of the emergency fund as the financial airbag of life. Liquidity is king when life smacks you in the face, and life will always smack you in the face in ways you cannot even foresee. It's just reality. And it gives you options, because if you don't have an emergency fund, this financial airbag, it can cause you to make poor investment decisions. It can cause you to go into debt. It can cause you to have to sacrifice your life. And so having a robust emergency fund. So as an example, in retirement, our default is you have a contingency fund, which is essentially an emergency fund. And then you have once you retire, you have at least 5 years of your expected spending from your assets de-risked, meaning not invested. It's going to be in treasuries. It's going to be in CDs. It's going to earn money. And 5 years can seem like a lot of money, and it can be a lot of money. But this is essentially creating your payroll reserve. You're paying yourself now. And now you could argue, especially we did this even when interest rates were zero, you could argue that this is not efficient. I could earn more money. I should buy this short-term treasury, or I should buy the short-term municipal fund or whatever. But that misses the point. The core of that money is you want return of your money for when life happens to you. And so I would prefer from an overall allocation perspective, even with someone who is younger, is to have what's called a barbell. You have a lot of liquidity, a lot of cash reserves, and then you have a lot of risk assets and not a lot in between. And so I think the emergency fund gives you options when life happens, and life always happens.
Yeah, it's interesting because if you have the barbell approach, because you have that cushion or that airbag, one can take a little additional risk on the other side.
Yes, and you can be statistically set up to have better results on the other side. It's easier to behave better with your risk assets if you're not worried that you're going to have to sell something to pay for the air conditioning going out or for your paycheck.
Yeah, I love that concept, Roger. And, pre-retirement, this is what I suggest to people in terms of having that emergency fund. So first, you're right that the emergency fund in and of itself is like the number one insurance policy, right? So I tell people that they actually need two funds, that they need a rainy day fund and they need a longer term emergency fund. So a lot of times we talk about these things and we use the two terms interchangeably, but I just want to delineate very quickly the differences because they are varied in size and scope and duration and purpose. So a rainy day fund, in my mind, is kind of like what it sounds like. When it's raining outside, you know that's something temporary. You throw up the umbrella and you're going to go outside, run out of your car or whatever into the office or to the store. But the rain is temporary and it's going to go away, right? So that umbrella is giving you that coverage that is just a short-term need. Well, likewise, when you have a rainy day fund, It's the fund that for most people, again, just average Americans, they can have anywhere from, say, $500 to maybe $1,500. And they can just throw that money at a problem, a one-time event. It's temporary, and that problem's going to go away. Oh, my tire, got a flat or something, or all four of my tires. I don't know. $1,500 might not cover all four, but you get the point of it. I don't know, a kid threw a baseball through my front window. The plumbing is messed up in the bathroom. I had to call the plumber, and now I got a $500 bill, whatever. So that rainy day fund takes care of a one-time event where you can, again, throw some money at the problem real quick and make that problem go away. Okay. Now, by contrast, the emergency fund is the longer term fund where you want to have, as you mentioned, Andy, a minimum of 3 months. 6 months is a good benchmark. And again, I don't want to discourage people, because people are like, oh my gosh, I don't even have 1 month of my expenses saved, right? But obviously you build toward this, right? You don't have to develop this overnight. You do it little by little. But the goal is to have at least 3 months worth of all your expenses. So if your bills are, say, $3,000 a month, then you want to have a long-term emergency fund that's a minimum of $9,000. And why do you do this? Well, the purpose for this fund is that it's designed to cover a much bigger scope of things. It's like, oh, I've lost my job, and now I need funds to pay for everything, to pay all my bills. Or, oh my gosh, my spouse walked in the door, hit me with some crazy news and said they're leaving, or they want to divorce. And now what was, a 2-income household is 1 income. And, oh, I have to pay all these bills, right? So that longer term fund it has a different purpose. And again, you shouldn't touch either one of them until the appropriate or designated emergency actually happens. But I think that it does help people to do a little bit of mental accounting, to put these things into pots, right? And then to know, okay, this right here is my rainy day fund. I'm not going to touch that. And then over here, I'm consistently building up to get towards my longer term rainy day fund. And then again, as you keep that and as you build, let's say you're in your 40s, or, you keep adding to it and now you're in your 50s. And then you've gotten to that stage, like Roger talked about, when you're in retirement. And if you keep building and amassing, right, then that crucial first 5-year period, yes, that can become your income stream, as it were, as he referenced, where you could kind of draw down on that. Not to mention that it'll help you to, put off having to tap into Social Security, and then you'll get an 8% bump each year, et cetera. So if you kind of strategize and do it right from a timing and planning perspective, it can really be very, very powerful in terms of something that people don't traditionally think about as insurance.
A really good way to think about it, I was thinking of, Lynette, and I like how you distinguish those two things. I think that's smart. I need to do that. Is I just went canoeing in the Boundary Waters, which is this series of lakes and islands. And I had to wear a life jacket the entire time. That life jacket slowed me down. I couldn't paddle as easily. I had to carry him with the other ones and, with the other people in my group. I was slowed down in my paddling because of this life jacket. If I had fallen in the water, though, I would have not been grasping to stay above water. I would have been floating there stable so I could make better decisions about what to do next. And that's essentially what this emergency fund does. It sets yourself up to be stable when life happens so you can make more thoughtful decisions.
Absolutely.
Totally. Well, thank you both for joining us. Our panelists did a great job of demystifying some complex topics, and we covered a lot, from investing to debt to emergency funds. As I said, while the financial services industry likes to make things complex, I think the takeaways are, if you listen to the panelists today, you can approach things simply. And when done consistently over time, you've got to address your money. And whether you're investing or paying down debt or saving, you can end up with a lot more money than when you started just by paying attention and doing things simply. So I want to thank Lynette for joining. You can find her at LynetteKhalfani-Cox.com. The Money Coach, you can Google her. Roger Whitney at RogerWhitney.com. I know that you've got a very popular podcast. How's your YouTube channel, Roger?
It's starting in January.
Awesome.
Working on the workflows right now. So
people can find you there. And I didn't mention that Michael Gayed, I knew that he had to step out early. I didn't explain that he just left. You can find Michael at the Lead Lag Report. Please join us next week for episode 5. We're going to be covering the generosity effect, the ripple of inspired giving. That will be next week, Wednesday, September 13th, 6 p.m. Eastern. Thank you again to the panelists and everybody out there watching. Just keep an eye on your money. And thank you.
Be well.
Take care, guys.